I want to move on to another topic because there's 4 or 5 of them I want to hit here. Private equity, private credit, very high levels of interest, but the assets are illiquid, and this is proving to be very tricky to provide in an ETF wrapper. We saw PRIV recently go public. There is some CLOS offerings out there. It seems to me like it's still not clear if ETFs will be the dominant space for trading private equity and private credit. Give us some thoughts on how this can happen, or maybe it not happen. Maybe BDCs is the better route to go. I don't know. It's very tricky here, it seems to me.
Look, I'll kick it off, and I'm sure we all have views on this. I think the great trend that's there is innovation, right? And that's always been a hallmark of the ETF industry, and I think that's what we're seeing happen. Now, the question that needs to be answered is, can you take a private that doesn't trade that much and is illiquid, and you have a premium for being illiquid, into the ETF wrapper? It needs to be priced on a daily basis, and you need to be able to have extra liquidity, and there needs to be a market for it. So I think there's still some questions that need to be answered around this, but those are some of the topics that need to be unpacked in terms of bringing this to the next level and making it a reality.
I think you can look at the financial space as so many different structures for different users and different asset types, right? Mutual funds still continue to make a ton of sense for retirement accounts, for more liquid assets where portfolio managers want to shield what they're buying every day. Interval funds have been really successful for private credit thus far. I do think a lot of winds are still blowing towards ETFs, and I think we'll see more innovation with private investments. One of the things we're looking at is, can you do more indexing of private investments? So we made an acquisition with Preqin this year, and a lot of it was really around the idea that if you have time series and you have the data aggregating a lot of what's happening in the private space, you can start to index private assets, and then maybe you can build some products off it. We've seen plenty of
Preqin does private credit analysis, essentially. I mean, you mentioned Preqin. Don't assume they know what they do, but that was a big acquisition for BlackRock.
Yeah, so they're an alternative data provider. They do, all different types of private investments, whether it's, private equity, private debt, et cetera. But what it opens up is the ability to potentially do more indexing of private assets. And what we've seen in the ETF space is you can index a lot of different things. You don't necessarily need to physically hold them. As long as they're indexed and you could have futures or other derivatives tracking those types of investments, you could potentially build an ETF that tracks
I guess,
them.
Ben Johnson, the question is, can we shoehorn private credit, private equity into the ETF wrapper? We have structures that already exist. Business development corporations, yes. BDCs, they do this. That's what they do. Interval funds, these are sort of like closed-end funds, for those of you who don't know, folks, and they've existed in this structure for years and years and years. Can you fit this somewhat illiquid asset and shoehorn it into the ETF wrapper?
Yeah, Bob, I think there are a few different questions here, which is, can we? We've proven that we can. Should we? I'm still not certain. And does it ultimately deliver what investors are expecting? I think at least in many of its current forms, I think back to the old Wendy's commercial where they lift the hamburger bun and they ask, where's the beef? Well, you're not getting a lot of beef right now because you have to water down a lot of what investors really want, what they're after, which is private markets exposure, to get it to work in an ETF
You have to water
wrapper.
down because the SEC won't allow a huge amounts of illiquid investments in a private fund, in a fund like this, right?
Yeah, so that's not to say we couldn't reach a point in time. And I think back to the example of bank loans circa 2011, where you looked at that asset class, you looked at the infrastructure, you looked at the liquidity, and we balked in that moment at the idea of ever wrapping bank loans in an ETF, but now it seems fairly commonplace, fairly mundane.
BKLN did that, actually.
Perfect example.
There's a bank loan, State Street did that, right?
Invesco did that,
I'm sorry,
so
excuse me.
I think a great example of where this might go, but for the time being, to Jay's point, there are already a number of different vehicle types, I think most notably interval funds, that allow you to get that exposure at the level that you want,
but they're not
the outcomes that you want.
Interval funds are not publicly traded, though.
They're not publicly traded, but they're ticker-based. You can subscribe daily in many cases. You're sacrificing liquidity on the way out because maybe you can only get out once a quarter. But nonetheless, you get fuller exposure to these private assets.
So your point is maybe we shouldn't shoehorn this into an ETF space because you're not really getting what you think. You think you're getting private credit, but in fact, there's a limitation to what you can do in this.
And I think interval funds and other evergreen funds,
are better vehicles.
Non-traded BDCs are kind of the middle bowl of porridge in this Goldilocks
Any
scenario.
thoughts here?
Yeah, I was going to say, first of all, I love the analogy for the first time with private credit, talking about the beef and Beyond Meat, sort of analogy, which is a great way to think about it. But I would just say, agree with sort of the comments that have been made, but stepping back, across our business, we are looking at an incredible amount of demand from ETF investors who are looking for access, which has been one of the hallmarks of ETFs from day one. And the other side of this is really those managers, especially who are focused on alternatives. Some of the largest investment managers in the world are looking to push more into that wealth space, to tap into that growth. And ultimately, it's about trying to meet investors where they're at. And ETFs obviously are the place where investors are going. But again, there's these other structures that are also trying to satisfy that demand.
Bottom line is it may or may not be the right structure, but we already have structures to address investing in private equity and private credit. I want to move on here. So another hot area, and this is somewhat in the active management space, is option income and buffer products that are out there. Option income products are very interesting that's going on with them. These are tapping into the interest in people who want to provide regular income, essentially. So these ETFs sell call options, and these are typically on the S&P 500, and they cap some upside potential but also provide a monthly income, essentially, from selling the call options. And the buffered products provide exposure to the S&P 500, typically the S&P, up to a limit, and then they provide a buffer against some of the losses. So these products have become very popular with investors who want to stay in the market, but provide some kind of downside protection. So we've seen this, Innovator, Bruce Bond's fund, some of the other ones that are out there. These products make some sense to me. Ben, how have these products been received? They seem to be gathering assets under management. Do they make sense to you too?
Look, clearly, when you look at the flows, there is demand for these products, and they're filling a need in the market. I think we've certainly seen a couple things. At this point in the market, obviously it's resonating with advisors. I think also there's been a tremendous amount of marketing and education that's gone on around these products. I mean, ultimately trying to raise assets, but that has also helped to really get the word out to advisors and also explain how these products can be used inside their portfolios, which again, until recently was not really well known.
Right. So in option incomes, and I want everybody to understand this point, you're selling call options, you're collecting premium, and you're distributing that to the investors. It depends on what the percentage is, 7, 8, 9, 10%. With buffered products, you get exposure to the S&P up to a limit, and then if it drops, you get downside protection. So what I like about this is these people aren't just exiting the market. I'm 70 years old, I'm worried, I want to drop my exposure from 70% stocks to 20% stocks, and I'm not in the market. I'm here, I'm still in the market, but I have a collar around me, essentially.
And I don't think it's just about exiting. I think a lot of this is about entering the market. When you see the trillions of dollars on the sidelines in money market funds, a lot of investors are using buffered products to step out of cash and into the markets. No one wants to be the person that held cash for 5 years, just put their money in the market and watched it sell off 10%. So using a product like a max buffer ETF that limits the entire downside at the beginning of its inception period with a capped upside can be a really good tool for kind of almost a replacement for dollar cost averaging, bringing people out of cash back into being invested in the markets.
This has been one of our biggest strategies, and as you know, with JEPI and JEPQ, we were an early innovator into this space to provide that outcome of being able to stay in the market and collect income along the way. We see it as there's multiple ways to win within a strategy like this. You can remain invested in the equity side and get the return from the equity market. You can capture that extra premium income that adds to, I think, a growing need and a growing desire for income investing across all asset classes. And so we see that as a really effective way to keep people invested. And usually when you come out of the market, that's when you lose the most. We want to keep people invested through the cycle. And so we've seen a lot of demand, especially this year, given the volatility in the market. That's where these products really shine. And that's been an effective
and
outcome.
JEPI, that was the leader in selling call options and collecting premium. What kind of yield are we talking about right now, like on JEPI? What's it throwing off?
So JEPI is taking a broad market access. That's what you get in the underlying portfolio, but you're getting 7%. On that. In the NASDAQ version, in JEPQ, it's about 11% now. So really attractive to keep people invested through the cycle.
JEPQ is the NASDAQ version.
Correct.
All right. So 7%. Now you are, of course, as people understand, you're selling a call option here. So you're giving up some upside protection.
Yeah.
But you're getting income at the same time.
That's right, and you should be willing to give up some of that upside in order to, it's a trade-off, but that's an effective trade-off, I think, in a market that's going to be a little bit more choppy, where you still want to have active management on the underlying portfolio, which again, I think we're going to see more and more appetite for active management just within overall broad traditional portfolios.
Ben, you want to say something?
Yeah, and Bob, I would emphasize that this is kind of an instance of almost like old wine in new bottles. None of these strategies or anything, in many cases, are unfamiliar
JP
to
Morgan's
advisors.
been doing this for their headier, more advanced clients for 30 years, right?
Right.
But now it's just in this wrapper that we see in BlackRock. You've been doing this for a long time, right?
Come back to everything that we know and love about ETFs is that they make it easier to tap into these strategies, to implement these strategies. They make it cheaper to implement these strategies to the extent that buffer ETFs at the margin are taking share from structured products, which can be really expensive, super illiquid, and generally just investor
That's the beauty of this wrapper. The guys like JP Morgan have been doing this for clients for decades, and now you actually have advantage of stuff that what you couldn't have done 30 years ago. You would have had to been a high-end client at JP Morgan. They would have done a custom portfolio for you.
Yeah, I think it's another fact that I think people are starting to realize is that in the active management space within ETFs, a lot of times you're bringing the best of your capabilities, as what we try to do, into the ETF wrapper. So you're right, we've been running strategies for 30, 35 years with great track records, and we're now introducing that to give the access of an ETF to those same portfolio managers, the same research analysts that they would have otherwise had in other vehicles, but now it just becomes easier to access those.